It's my absolute pleasure to welcome Simon Raubenheimer from Contrarius Asset Management, all the way from Jersey. About 2 weeks ago, you would have seen him one of the offshore webinars, and Simon normally presents on the Contrarius Global Funds, I think you're all familiar with. They recently launched SA Multi-Asset High Equity Fund and an equity fund. So very interesting to see how you're playing in the SA space. But Simon, this is familiar hunting grounds from you, from your ex-Alan Gray days. I think it's been a decade since you last been in Pretoria. So really great to have you here. And I think a lot of our audience members here also recognize you from those times. So great to have you here, and we look forward to your presentation. Thank you so much.
It's always a big pleasure to be here. Thank you to BCI for the platform, and thank you to Eugene for wearing a tie and not making me feel like the odd one out. It's fantastic being back in Pretoria. I was born here, I grew up here, went to school here, went to study here. I've still got my old professor in the audience, so if my economic theory today is a little bit wobbly, then you speak to my professor here. So most of you will know Contrarius for managing global funds. You would have hopefully over the course of several BCI seminars heard us talk about our global equity and our global balance funds. What many of you don't know is that we recently launched South African funds, in fact, and I'm here to talk about those South African funds specifically. So I guess the first few questions, why did we decide to launch in South Africa? Well, the one thing, this slide here shows consumer confidence and business confidence. So business confidence in red and consumer confidence in blue. And you can see that the sentiment in South Africa is extremely negative, both from businesses, but also from consumers. Most people are finding conditions very tough and are pretty pessimistic about their outlooks. Again, that's both businesses and consumers. And you can see that that has been the case for a number of years. So sentiment is very depressed. And you've had continued outflows from foreign investors. So the red line there, going back all the way to 2017, shows foreign net equity outflows on an annual basis. And the blue line there shows on a cumulative basis what's happened to foreign investments into equities in South Africa. And you could see over the past, that's kind of 7 odd years, almost R1 trillion has been taken out of the stock exchange just by foreign investors. And we look at what a lot of the local investors are doing, they're actually following suit. So they're also heavily invested in the rand hedges and the offshore stocks. And you see a similar theme sort of unfolding when it comes to South African incorporated equities. You can also see there that the GNU last year made very little difference to foreign flows, and actually this year they continue to run at more or less the same annualized rate that they were running at last year too. So outflows are bad, sentiment is poor, and as a result, the South African market, when measured in US dollar terms versus the MSCI World Index, has underperformed for a number of years. You can see it has started turning up more recently, but it's still only a blip on a sort of a longer term chart. So as a contrarian investor, as a company who are drawn to things that are neglected or misunderstood or unloved, this is a market that naturally appeals to us. So that's why we launched in South Africa. I guess the second question is, are we able to do things differently to what everyone else in South Africa is doing? So what we've done here, and this graph requires a little bit of, this table requires a little bit of explanation. So the second column there shows the top 10 shares that are currently held in our South African fund. So it's Naspers. I've just put Naspers and Prosus together. So Naspers is our biggest share, Prosus is our 8th biggest share. The JSE is our 2nd biggest share, African Rainbow Minerals our 3rd biggest share, and so down the list we go to PPC Cement. What we did here is we looked at the Alexander Forbes 2024 survey, which is the most recent data we could get. And we said, we take the top 10 asset managers in South Africa, all right, and we grossed up their equities and their domestic assets under management by what markets had done. And then we said, if we just assume that 50% of their domestic assets are invested in shares, Okay, so it's not an exact number. I don't know whether it's 40 or 50 or 60%. We just said assume 50% of their South African assets are invested into equities. If these top 10 asset managers on average are extremely optimistic about these shares, and they were to buy 20% of each of these businesses, how big would each of those positions be in their, as a percentage of the shares that they manage? And you can see for a company like the JSE Limited, which has maybe a 12 billion rand market cap, if the average of the top 10 managers in South Africa were to buy 20% of the JSE, assuming 50% of their South African investments are sitting in equities, it would only make up 1% of their shares. Assuming they bought 20% of Sun International, again, a 11 billion odd rand company, it would only make up 1.1% of their shares in issue. Assuming they bought 20% of PPC Cement, it would only make up 0.7% of their domestic equities. So if they were very bullish on these companies that we like, we think the valuations are cheap, it wouldn't move the needle for most of the larger guys in South Africa. And actually, if we look at the liquidity on the South African market, here we take, we assume here that you buy 15% of the daily volume-weighted average price. 15% is what we utilize in our funds globally. We seem to find that's a level that works. You can buy at that level of, call it aggression, without disturbing the share price. So if you buy 15% of the daily volume-weighted average price, how long would it take you to buy 20% of each of those businesses? So to buy, and you can see for companies like the JSE, if they were to buy 20% of the JSE at 15% of the daily volume, it would take them 32 months to buy. It would take them 53 months to buy Sun International. Here we only look at the shares trading in South Africa. So for a Glencore, for example, Glencore shares are fully fungible between South Africa and London, so that's only the liquidity on the South African market. But for many of those shares like PPC Cement or Sun International, those shares don't trade anywhere else. This is how long you'd have to wait. 53 months if you bought 15% of the daily volume weighted average for a company like Sun International. So if you are bullish on Sun International, you have to buy it 4 years in advance. That's months, not days. That's how long it's going to take you to buy 20% of that position. So we think the market structure lends itself to a smaller manager, and we think we are sufficiently able to be very different to what everyone else is doing. I guess the third question is, are we willing to be very different? Well, again, I look at our top 10. Here we look at the top 10 holdings of, again, those 10 largest asset managers in South Africa. And we say, across all their portfolios, how different are they all looking? Well, 9 of them own Naspers, of the top 10 managers. 9 own Prosus, 9 of them own FirstRand, 8 of them own Standard Bank, 7 of them own AngloGold Ashanti, and so down the list you go. So there's actually a tremendous amount of commonality amongst the top 10 asset managers in South Africa. The top 10s largely look more or less the same. Different weightings, but very, very similar. Again, we only own Naspers and Prosus. Our portfolios look very, very different. So yes, we are willing to be very different. You can look at our top 10, and again, you'd see Naspers there, and Prosus number 8 is the only overlap we have with the other managers, certainly the large managers. And when you look at it from a sectoral point of view, you look at what's in the benchmark, and you look at what's in our fund, you can see overweight basic materials, underweight consumer staples, for example, overweight consumer discretionaries. Again, our weights are very, very different to those that are held by the market indices and those held by the average manager. I guess the fourth question is, well, we think the market's attractive because it's unloved, it's out of favor. As you saw, you've had continued outflows. We think we are able to be very different. We think we are willing to be very different, as you can see, but can we outperform? So I guess the only long-term thing we can point towards there is the long-term track record of our global equity fund, which you can see there. We launched in 2009, and you can see our global equity fund in blue compared to the MSCI World Index, which is the average stock exchange around the world, and compared to the average manager there in black. And you can see, had you invested with the average manager in January 2009 when we launched, you would have made roughly 4 times your money. Had you invested with the MSCI World Index, so just had your money sitting in a low-cost tracking fund, you would have made around 6 times your money. And had you given your money to us to manage, you would have made around 9.5 times your money after fees. So again, we think we have demonstrated the ability to outperform over long term, admittedly with some volatility, but as we always say, volatility, we feel, is the price of admission. And if you truly do look different, then your returns will be very different to those in the benchmark, and you will have some volatility. So what are the opportunities that we're seeing on the JSE? I'll just take you through 2 examples of the value that we see in the South African market. The first of those, here we look at a basket of stock exchanges. So here's the Intercontinental Stock Exchange, or ICE, the Chicago Mercantile Stock Exchange, the London Stock Exchange, the Hong Kong Stock Exchange. We've got the Australian Stock Exchange here. So this is a basket not of the indices, but of the actual operating businesses who run the exchanges. So these would be the competitors to the JSE Limited, right? And you can see, again, this is more or less the history of our global fund. Had you invested in these global stock exchanges, you would have made almost 8 times your money. So it's been a great place to be globally, is to own the actual stock exchange operators. But look at how the JSE has performed relative to that basket of stock exchanges. From a sort of a peak, that euphoria leading up to the 2010 World Cup, things have just fizzled out and gone down and down and down. And from that peak, the JSE is down probably 80 or 85% relative to that basket of international stock exchanges that I showed you on the previous chart. Again, as a contrarian investor, we like to own things that are out of favor. This to us looks pretty out of favor. The JSE is a great business, has a near monopoly in South Africa, similar to many of the other stock exchanges elsewhere in the world, but is trading, as you can see on this chart here, at substantial discounts to many of the other exchanges all around the world. So this, again, shows a table of, there's the Chicago Mercantile Exchange. That's a $103 billion company. The LSE, the London Stock Exchange, is a $70 billion company. So these are massive exchanges all around the world. And you run down the table, you can see right down at the bottom, just below that average, there's a JSE, which is only a $0.65 billion company. So tiny, tiny. But look at the valuation of the JSE versus the valuation of these other indices. And here we've just pulled the Bloomberg consensus forecast numbers. These aren't even our forecasts. This is purely objective. On a 1-year forward price to earnings multiple, these other exchanges trade at between 25, 26 times earnings. You can see the average at 25.7. The JSE trades at a multiple of 10.9. That's an almost 60% discount to exactly the same business elsewhere in the world, right? And on a 2-year forward basis, we're again at an almost 60% discount to other exchanges elsewhere in the world. And of course, it's because of all these factors that we discussed earlier. The stock exchange, the South African markets had continued outflows. The markets are depressed. A lot of people aren't participating in the South African market to their full extent. And those things feed on themselves, and you're finding these tremendous opportunities of value on the JSE, which includes the JSE operating business itself. So that's one example. Another example in a completely different sector is African Rainbow Minerals. Now, African Rainbow Minerals is a mining company, and it's a bit of a conglomerate. It owns 75 million shares in Harmony Gold. Those 75 million shares in Harmony Gold, I've shaded in gray, are worth 100 Rand per African Rainbow Minerals share. In addition to those 75 million Harmony shares, African Rainbow Minerals has more than 20 Rand, actually 22 Rand per share of net cash. No debt, only cash. So if I take African Rainbow Minerals' stake in Harmony off its market capitalization, and I also subtract the net cash, and I look at what's left, that's that light blue line. So what's left is we call here the rump of African Rainbow Minerals. So those are iron ore mines in the Northern Cape, manganese mines. They've got 3 platinum mines. They've got coal mines. In a good year, the rump of African Rainbow Minerals plus the net cash, so all the assets excluding Harmony, in a good year, so back in 2021, those assets generate 60 Rand, more than 60 Rand per share for shareholders. Right? You're currently only paying 80 Rand a share. So it's on like a 1 PE of peak earnings. And even in a more normalized year, it earns between 20 and 30 Rand a share for something that you're paying less than 80 Rand for. So it's like between a 3 and a 4 multiple in a normal year. In a good year, it's a 1 multiple. And actually, the gray block there, which is the stake in Harmony Gold, I don't know if you guys have paid attention to the gold price, but at $3,700, $3,750 an ounce in gold, Harmony itself is only on around 6 or so times earnings. So you're paying a 6 multiple for Harmony, and you're paying a between 1 and 4 multiple, call it, for the rest of African Rainbow Minerals' other businesses, which we think is just too cheap. This is the Rand hedge. It's exposed to commodities that are going up, and you wouldn't find these opportunities in many markets around the world, which is why we think South Africa is such an exciting place for us to look. You don't need conditions to be much better than they currently are. All you need is things to be maybe just a little bit less bad, and you could get quite a sharp return in foreign flows. And given the extent to which South African assets are under-owned, the potential upside could be very, very large. These are just 2 examples, but across our funds, we own numerous companies that are exposed to the South African economy that are trading at very low single-digit multiples and very high, almost double-digit dividend yields. This doesn't happen very often. So the 3 funds, as Eugene said, 2 are equity funds. One is an equity-only fund, which is 100% invested in South African equities. You can see that's our SA equity fund. One is a general equity fund, which is 63% invested in South Africa. In terms of Reg 28, can go up to 45% offshore. We're currently sitting at 35.7% of equities outside of South Africa, and those equities mirror what we hold in our global equity fund. And then we also have the balanced fund, which again can invest up to 45% offshore, is currently 56.8% invested in South Africa, of which 36.4% is in equities. And this one has 43% of this fund is invested overseas. And those are in assets that replicate our global balanced fund. So in a nutshell, we think this is a great opportunity, and I'll maybe close it there. I'm happy to take some questions.
Right, many thanks, Simon. Any questions from the audience for Simon? We won't charge you. You're welcome to us. Right.
There's it.
Simon, on JC Limited,
Yeah.
what factors do you believe will turn that around? Because we've seen years of decline. What do you think can happen that can give a positive impetus to that share?
Yeah, I mean, I think at some point valuations are just so low that in itself starts attracting capital flows from elsewhere in the world. You've seen those flows consistently negative for a number of years, and you're also seeing a lot of markets elsewhere in the world trading at all-time highs. The S&P, for example, trades at a multiple of in the mid to high 20s. And actually, markets in Japan, markets in Europe, elsewhere in the world have run really, really hard. So I think at some point, just the fact that it's so under-owned and so neglected, at some point you get to a point where the last marginal dollar has already left. There is no more capital to leave. And then from there, you can only have sort of one-way traffic. But South African businesses are doing a good job navigating understandably a difficult environment. So we're seeing companies with tremendous management, really dynamic, investor-friendly, paying very high dividend yields. The Rand looks like it's strengthening. Commodity prices will provide further support, so a high gold price, high platinum prices. Again, you would think at some point that starts attracting foreign capital, and all those benefits start trickling through to domestic companies. So listen, I'm not naive about the issues that South Africa faces. We've got family here, we have an office here, we're very close to the conditions on the ground. All you need is for things just to stay kind of the way they are or stable. And we think the upside to valuations are tremendous on South African consumer businesses, on South African banks. Even South African commodity companies haven't fully yet priced in higher platinum, higher gold prices. We find very low multiples across the board. But it is very difficult to identify a catalyst. I guess once that catalyst is there, it's too late because the market will move in anticipation of that catalyst. So once it's obvious, it's, the horse is bolted.
Very interesting indeed, because I mean, if you look at the trends in our market, we don't really see international or global fund managers launching funds in SA. And I'm not talking about feeder funds, I'm talking about SA equity funds.
Yeah.
So our market's really definitely exciting, and it's good for us to be able to access your skill set on SA-based funds as well. Very quick question, views on gold. I mean, gold's been a huge tailwind for our terms of trade, for a big part of our markets, for some of the companies you showed. Is this a time to take profits from gold, or what do you think?
I mean, it's very difficult to predict the gold price, but if I look at sort of what's happening at the moment and what may come to pass over the next few years, you're moving into almost a perfect storm for real hard assets, tangible assets, anything that's not cash, with investors losing faith in central banks, in fiat money, not really trusting governments, heightened political risk, several wars happening around the world. We think this is a great tailwind for higher gold prices, but also prices of, I mean, I think part of that is also why markets are high. Part of that is why Bitcoin's high. People are looking at alternatives to cash. So I would not be surprised if gold goes through 4,000 and in time through even $5,000 an ounce. It could certainly happen.
We are recording this, so it's really great for you to give us those numbers. Right, next we've got Zanile from 361 Asset Management. Zanile, if you can come to the front, thank you so much.